The year 2026 was supposed to be the era of the Great Recovery. After years of battling inflation, fluctuating interest rates, and the rapid integration of artificial intelligence into every corner of the stock market, the average retail investor felt they had finally earned their seat at the table. But as the data rolls in, a haunting reality has emerged. 90% of people who put their money into the markets this year are losing. Not just losing against the S&P 500, but actually watching their purchasing power evaporate. But why? Why? In an age where information is more accessible than ever, where we have AI tools to analyze balance sheets in seconds, is the failure rate higher than it was a decade ago? To understand this, we have to look past the charts. We have to look at the story of the silent trap. Imagine a vast ocean. In 2020, the tide was so high that every boat, no matter how leaky, was rising. In 2026, the tide hasn't just gone out. The very chemistry of the water has changed. The 90% are still using the same old fishing nets, wondering why they're coming up empty. They are failing because they are playing a game that no longer exists. The first reason for this mass failure is what we call the ghost of recency bias. Most investors entering the market today have their psyche scarred by the volatility of the early 2020s. They are conditioned to buy the dip without ever asking what they are actually buying. In 2026, a dip is often not a temporary discount. It's a fundamental repricing. The 90% treat the stock market like a casino, where the house always wins. But they forget that in 2026, the house has upgraded its software. They chase the next big thing, the AI-integrated biotech startup, or the decentralized energy grid, without realizing that the hype cycle has shortened from years to weeks. By the time they see it on their feed, the 10% have already exited with their profits. This brings us to the dopamine debt. The 90% are addicted to the green candle rush. We live in a world of 1-5-second clips and instant gratification. Investing, by its very nature, is the opposite of that. It is the art of delayed gratification. In 2026, the markets are more algorithmic than ever. High-frequency trading bots are designed to hunt for human emotion. They look for your fear. They look for your greed. When the 90% see a 5% drop in their portfolio, they feel a physical sting in their chest. They sell, the bots buy. When they see a stock skyrocketing, they feel the fear of missing out, FOMO. They buy at the peak. The bots sell. The 90% are essentially funding the lifestyles of the 10% because they cannot control the 3 pounds of gray matter between their ears. Now, let's talk about the illusion of knowledge. This is perhaps the most dangerous trap in 2026. Because everyone has access to ChatGPT or advanced financial dashboards, everyone thinks they are a sophisticated analyst. They can recite P/E ratios and debt-to-equity numbers, but they don't understand the Times narrative. They have data, but they lack wisdom. The 90% are drowning in information, but starving for perspective. They follow finfluencers who prioritize clicks over capital preservation. They invest in companies they don't understand, based on a 60-second summary they saw while scrolling in bed. They are intellectually lazy while being digitally active. But there is a bridge. There is a way to cross over from the 90% to the 10%. And it doesn't require a PhD in finance or a billion-dollar algorithm. It requires a fundamental shift in your internal narrative. The 10%, the elite group that is actually building generational wealth in 2026, operate on a completely different frequency. They don't look at their portfolio every hour. In fact, some don't even look every week. They understand that the market is not a scoreboard. It's a mechanism for transferring wealth from the impatient to the patient. To be part of the 10%, you must first adopt the first principles of 2026 investing. The first principle is, cash flow is king, but conviction is the kingdom. While the 90% are chasing moonshots, the 10% are quietly accumulating boring, unsexy assets that produce consistent cash flow. They are looking at dividend-growing companies that have survived 3 decades of turmoil. They are looking at value when everyone else is looking for growth. They understand that in a high-interest rate world, a company that actually makes a profit today is worth 10 companies that might make a profit in 2030. The 10% also practice selective ignorance. They have learned to turn off the noise. In 2026, the news cycle is a weapon of mass distraction. If you listen to every breaking news alert, you will be paralyzed by fear. The 10% have a written investment thesis for every single asset they own. If the stock price drops 20%, they don't check the news, they check their thesis. If the reason they bought the company hasn't changed, the price drop is a gift, not a threat. They have the stomach for the market, which is far more important than the brain for the market. Furthermore, the 10% understand the power of the boring. There is a certain boredom that comes with successful investing. It's like watching paint dry or grass grow. If your investing is exciting, you're probably doing it wrong. The 90% want the thrill. The 10% want the result. The 10% utilize automated discipline. They don't trust their human emotions, so they remove them from the equation. They use dollar cost averaging DCA into diversified index funds or high-quality dividend ETFs. They have set up systems where their money is invested before they even have a chance to think about spending it. They have turned wealth building into a background process, like a software update on your phone. But the most significant difference, the one that truly separates the winners in 2026, is their time horizon. The 90% are looking at the next 6 months. They want the Tesla, the house, or the luxury vacation by the end of the year. This short-term thinking forces them to take unnecessary risks. They use leverage. They trade options they don't understand. They bet on earnings calls. The 10% are looking at the next 20 years. When you have a 20-year horizon, a market crash is just a blip on the radar. It becomes an opportunity to buy more of the world's best companies at a discount. The 10% understand the eighth wonder of the world, compound interest. They know that the real magic doesn't happen in year 1 or year 5. It happens in year 15 and year 25. They are willing to look stupid or slow in the short term to be wealthy in the long term. Think about the story of 2 investors, Alex and Sarah. Alex is part of the 90%. He's smart, he follows the news, and he's always looking for the edge. In early 2026, he hears about a new AI-driven energy startup. He puts 40% of his savings into it. The stock jumps 20%, and Alex feels like a genius. He tells his friends, buys a new watch, and starts looking for the next winner. But then, a competitor releases a better product. Alex's stock plummets 50%. Panicked, he sells everything, swearing that the market is rigged. He's left with less than he started, and more importantly, he's lost his confidence. Then there's Sarah, the 10%. Sarah doesn't care about the AI startup. She spends her time researching a boring utility company that has increased its dividend every year since 1995. She also puts a large portion of her income into a total world stock index. When the market is volatile, Sarah goes for a walk, reads a book, or spends time with her family. She has automated her investments. She doesn't feel like a genius when the market is up, and she doesn't feel like a failure when it's down. By the end of 2026, Sarah's portfolio hasn't mooned, but it has grown steadily. While Alex is out of the game, Sarah is just getting started. 10 years from now, Sarah will be financially free, while Alex will still be chasing the next big thing to catch up. The tragedy of 2026 is that the path to the 10% is wide open and clearly marked. It's just not exciting. It doesn't make for a viral TikTok. It doesn't give you a rush of adrenaline. It requires you to be disciplined when others are distracted, to be patient when others are panicked, and to be humble when others are arrogant. So, as we navigate the remainder of this year, ask yourself, which story are you writing? Are you the 90% investor who is constantly reacting to the world? Or are you the 10% investor who is letting the world work for you? The markets in 2026 are not designed to be fair. They are designed to be efficient, and they are very efficient at taking money from those who have no plan and giving it to those who do. Stop looking for the secret or the glitch in the system. The secret is that there is no secret. There is only the relentless application of sound principles over a long period. The 90% fail because they try to beat the market. The 10% succeed because they times the market and let time do the heavy lifting. You don't need to be the smartest person in the room to win in 2026. You just need to be the most disciplined. The choice is yours. You can continue to chase the ghosts of quick riches and follow the herd off the cliff. Or you can step back, breathe, and start building your kingdom, one boring, consistent brick at a time. The 10% are waiting for you. It's not a crowded place, because the entrance fee is patience. And in 2026, that is the rarest currency of all. Watch the 90%. See what they do, hear what they say, observe their anxiety and their constant need for the next move. Then, do the exact opposite. While they are busy checking their screens, you should be busy living your life, knowing that your wealth is growing in the silence. That is how you win. That is how you survive 2026. And that is how you become truly free.